everybody. Welcome to Trader Merlin Show. It is your Wednesday edition, the important Wednesday, Fed announcement Wednesday. Decisions were made. I told you I was in that 0.2% camp. I said, no, not going to happen. They should not raise today. However, Jerome Powell and his cronies listened to the show yesterday and they said, screw that guy. F Merlin, we're gonna raise rates 25 basis points, and hell, we'll probably doing even more going forward. So the good news is I have a counterpoint here, a counter argument that can be made, and Bill Addiss will be joining us in just a second to talk about that, so we can go over why I thought they should hold. And Bill's going to tell me why I am crazy and there's no reason that they should hold at all. Keep the pedal to the metal. That said, we've got our wonderful graphic here today. FOMC rate hike, 25 basis points. Mr. Bill Addiss joining us, the bond king himself. No video today because for some reason the audio is a little bit off. So I will bring up the graphic here. Bill, how you doing, my friend?
I am doing wonderful on this rather boring announcement day, right? But I am doing wonderful. It's good to be with you and your audience.
I mean, it was baked in. I mean, the Fed funds futures as of yesterday was like, not only was there no chance of keeping where it was even, it was like a 99.6% chance of a 25 basis point raise and a 0.4% chance of a 50 basis point raise, which I thought was like really aggressive. So how before we dive into the justification, why he did it, you read my article for Bar Chart, and you go, I'd like to make some counterpoints to that. So for those who might be joining us who are new, my argument was you have all these rate hikes that have happened since 2022, and it's been really aggressive, 5.25 points in 16 months. Those take time to filter through to the bottom line. The data dependent, which Jerome Powell says, we're going to be data driven. He said it every meeting over and over and over again. The data is showing inflation is cratering right now. It's now contracting. We're not contracting, excuse me. It's at 3% on CPI, but had been falling from 9.1% in March of 2022. So it's really dropping fast. We still have 5 more rate increases that have not yet hit that bottom line of economic data. They paused at the previous meeting. So if you're going to keep your pedal to the metal, why pause at all? Why not just pause and wait a few months to see what the data looks like, since the trend is down on inflation, the trend is staying sideways on unemployment, GDP is actually slowly creeping up. So why on earth would they keep on raising, Bill?
Great question, Merlin. And I feel like it's I'm dating myself. Remember the old Saturday Night Live, Jane Curtin, Dan Aykroyd, point, counterpoint?
Good stuff.
Merlin, you ignorant, whatever. Anyway, first off, let me say, and let's acknowledge mutual ground and commonality here. The rate of inflation has dropped dramatically and precipitously. Absolutely. You know, from a month-over-month high of 9.7 down to, below 4, great inroads have been made. But I also would acknowledge that we still have a good way to go. Inflation is still twice what the Fed would like to see it at if we look at a year-over-year 4.7. So now the question then becomes, okay, if this drop in inflation continues, then perhaps further rate hikes would not be necessary. But the key word there is if.
Yeah,
I would just as easily add if inflation goes back up. And I can point to agricultural factors, a little war going on in the Ukraine. We haven't had the energy crisis yet, we thought, would winter come. There's a whole bunch of variables that you can do an if either way. If inflation does continue to drop, if inflation goes back up. I just worry that inflation is insidious. I really do worry that it's going to be hard to break the back of inflation. Personally, I wish they didn't have a 2% goal.
Right.
I think in today's economy, that's an unrealistic expectation. So, my problem with the Fed is that they set a goal that I think is just not necessary. You look at other countries, they've got a level of inflation that's higher because they've got a GDP that's higher. So, inflation is relative to your growth. And let's face it, our economy has shown good resilience. I admit that. But unfortunately, with that good resilience comes inflationary pressures. So you're kind of damned if you do, damned if you don't. Well, so I think the key does come down to, what is the next couple of months going to bring? And I think they're going to be critical. We do have 2 CPI reports before the next Fed meeting. This is kind of a interesting timing. So we'll get 2 of them. So in all fairness, the Fed will have a better handle on things. So your argument to wait, I can understand that. I don't necessarily agree with it, but I can certainly understand that. And I also agree with your point that there is a lag effect. When the Fed raises rates, the response is not instantaneous. We're washing an elephant with a toothbrush here when we try and affect the economy by changing the Fed funds rate. It takes a long time.
Right.
But I do worry about the insidiousness of inflation. I guess that's the bottom line.
And the only reason I'm such a, I guess, staunchly in my opinion that we should pause is just because that rate increase of 5.25 points in 16 months is the most aggressive since 1980. And,
Yep.
And of course, a lot has happened since then. We learned from what's happened, although I would say that this is uncharted territory because of the sheer money printing that we've gone through. And, so worst case is, you put the brakes on. It's your second meeting in a row you pause, and maybe inflation does start to tick back up. Okay, great. You can start to raise from there. But my concern is you put the brakes on so fast. Like you have stomped on those brakes by raising, 75 and 75 and then 50, 50, 20, 20. You're going to grind things to a halt, but we still have to wait for that vehicle, our economy, in essence, to come to a stop. And my concern is we might overshoot. And what's the possibility here that all of a sudden inflation does go negative when we see deflationary prices because of the aggressive actions? I mean, we could go too far the other side of the pendulum here from, super inflation to all of a sudden none at all. And we got a whole new set of problems that's created by the Fed yet again.
Absolutely. But again, I like this point counterpoint. I would point out, though, that when the Fed got aggressive on their quantitative easing, that what they did was so dramatic, so unprecedented. We've talked about it numerous times, right? $4.5 trillion in 6 months.
Mm-hmm.
This was QE on steroids, right? You know it. Money supply, M1, is up 500%. The Fed's balance sheet triples. I mean, literally what our Fed did was so draconian, so dramatic. We need them to be just as draconian on the other side. I really believe that. Again, my foundation being inflation scares the hell out of me. Too much money, too few. I mean, look, 500% increase at M1. We've talked about this. We have to take dramatic actions to counter it.
Yeah, I agree. But the actions have been dramatic. Oops, sorry, I got the wrong graphic up. I think the actions have been dramatic, and here we are now, not knowing where we're going to go. And again, I certainly would not want to be in Jerome Powell's position. He's got the eyes of the world staring at him. That poor guy's got to go home and just pop some Xanax after every FOMC press conference because he's just
absolutely. Absolutely.
He's getting grilled out there.
Grateful Dead concert. He's following Jerry. He's following Slash in the group. No, I also have to point out, though, that I actually am rather pessimistic because, although I feel we've got some fighting to go yet on the inflationary front, I really don't think we're done. I also have to acknowledge I don't believe in soft landings.
Oh,
right. Ultimately, this will result in a recession.
Remind me never to get on an airplane with you then.
Well, I just looked, we've had 7 inverted yield curves. We've had 7 times the Fed has had the chance to play with a scenario not unlike this, but everyone is different. And every time the result has been a recession.
Mm-hmm.
The press loves the idea of a soft landing. And in your strategy, that's what you're looking for. Right. I mean, that's what you're really hoping the Fed would do was slow down and let's make this a soft landing. Fed doesn't operate that way.
Well, hey, Bill, could you imagine?
The soft landing is a great concept, but I've never seen it.
It is a great concept, but, could you imagine the reaction of the market? So he always, talks about, we expect to have a soft landing, everything's going to be fine. Well, it would be a bit different market if all of a sudden he said, I'm going to need everybody to duck their head between their legs and kiss your ass goodbye because it's going to be a hell of a crash. I mean, he's not going to say that.
Well, in fairness, though, that is exactly what the Bank of England said at their last meeting. I mean, they said we're looking for a recession that's going to be a year long.
Oof.
They said we're looking for inflation to not peak out before 13%. And then the next meeting, they did a complete reversal. They went from going from a year-long recession to now saying they're going to have positive GDP next year. So, I mean, central banks can swing their voice.
Yeah.
It doesn't do much for credibility, obviously. That's the issue.
Yeah.
But my fundamental problem out of all of this is I don't understand why they're holding to a 2% inflation rate. That seems to me the thing that I have the most questions about.
So a couple of things I'll dig a little bit deeper on. What is it about a 2% target that perplexes you? Because I think at least at a high level, I look at that 2% target, and it's something that we as Americans can hang our hat on. Say, okay, I now know that they're shooting for 2%. Therefore, when I look at the core PCE price index or CPI numbers, and I see, okay, we're getting close to where they need to go. At least it gives us a target. But you're right. I mean, why 2%? I don't quite understand that either.
It just seems unrealistically low in today's environment. I mean, would most employees be happy with the 2% pay raise? Would you be happy with a 2% increase to the value of your assets like real estate?
Yeah.
I don't think 2% in today's market is an attractive enough. It just doesn't make sense. I'm an advocate of the U.S. economy. I think our GDP is the strongest, most resilient, and I think our GDP substantiates a level of inflation higher than 2%. Most of us would be unhappy if the factors that attributed to inflation only went up by 2%, excluding food and energy, of course. We'd like them to go down.
Right.
But I just think 2% is too low. I really do.
Well, I mean, our most recent GDP number, which I have right here for you guys, this is actually going to be coming out next week. The advanced GDP, which is usually the most watched one because it goes advanced, preliminary, and then final. They're expecting to see a contraction here. I'm bringing up the GDP for you guys, and I'll zoom into the most recent after the pandemic swings. It doesn't look that great. We're fairly low, but expectations are we're going to come out at 1.8% GDP, which of course our historic average going all the way back into 1948, I believe, is 3.1%. So we're not atrociously bad right now. But let me piggyback on the last. Let me piggyback on the last comment you made. You said, inflation at 2%. We want that kind of growth. But if our GDP averages since 1941 3.1%, would that be an appropriate inflation number, having 3.1, because now you're in line with GDP?
Yes, it would. Yes, it would. Yes, it would. I'm saying I really do believe once we get this headache out of the way, the U.S. economy is fundamentally strong. I mean, I am pro-economy. I'm not as negative as it sounds. So I would be looking for a rate of growth coming out of this ultimately at greater than what we were as the average. Yeah, I think we'll come back strong. I really do. And I think that 2% is fine in a recessionary environment because you got deflation.
Right.
So if we're going to be hitting a recession now, the 2% should be achievable. I'm talking about the next swing, when we get out of this, because market swing. Well, you know that. But no, going into a recession, 2% is good. In a expanding economy, which this will lead to, I think 2% on a sustained basis is going to be low.
At some point, we'll get to an expanding economy. Right now, that's questionable. Let's go back to your comment about recession. It seems to me that you are very optimistic. If I was to have a probability spectrum of 0 being no chance in hell and 100% guaranteed it's going to happen, where are you on a recession is going to happen spectrum there?
I'm going to be almost close to 100%, but not within 14-month time frame. As I said, I think we've still got some inflationary pressures to deal with. That's where we kind of might disagree a little bit, but I do think ultimately we are heading into the recession, but I don't think it'll necessarily. So if we look at the 7 inverted yield curves that we've had, this phenomenon having been replicated 7 other times. At 7 times that the bond market predicted the inversion, we got it with 100%. On average, it took 14 months. Now, the longest of those 7 periods was actually 18 months. So I'm not saying necessarily going to go 18 months, but I don't think we'll hit the average of 14 because that would mean we'd have to dip into the recession within the next month. We're just coming up on the 1-year anniversary or almost of the inversion. So 14 months, I think, might be a little bit quick. That would put it 2 months from now. Might take a little bit longer than that. But yeah, I think almost 100% probability. I'm a bond guy. 100 every time the yield curves got inverted, we've got a recession. 100%, 7 for 7. So the bond market went inverted last year. I have no recourse but to say we're going into a recession. Well, and for those people who say this time is different, every time has been different. Right. Every inversion has its own unique characteristics.
Yeah, as they say in Asia, same but different. So. And I'm with you. It's just I'm trying to look in my mind as to what that's going to look like, how it's going to take shape, because all of a sudden it seems like our economic data starts to get a little bit better and a little bit better. It's like, okay, wait a minute, are we actually going to pull out of this? I shake my head. I agree with you. I don't know if I'm at the 100%. I feel like there's going to be one at some point, but right now it feels like things are starting to cook. It feels like things are looking better. Now, we're having all these companies beating earnings. Again, you have inflation is declining rather rapidly. Granted, the CPI, the most recent number of CPI popped up ever so slightly. Again, unemployment barely rising. GDP.
And I was going to rub that in your face. But I was trying to be diplomatic.
Please do.
Inflation's gone down. I would say I'm not so sure I feel comfortable with that. Some people look at last month and say, "Uh-oh, here it comes."
Yeah, and that could be. I mean, it's 1 point data. So let me.
Yeah, exactly. That's why I didn't make a big deal about it.
Hey, you're welcome to throw anything in my face. As long as it's done in an amicable way, I could care less. It's That's the reason the markets are great, because we all have opinions. So let me show everybody here the core this is CPI numbers, because the core PCE, they don't price it year over year, which is kind of weird to do that. Here is that inflationary chart, and this has kind of been one of the reasons I think that there should have been a pause. Is if you're targeting 2%, we're at 3% right now year over year. And that was the number we just got back on July 12th. And it's been falling aggressively. The previous number before that was 3.8. And all of a sudden, the next month, we went to 3.0. We're falling really quickly. If that rate by September will be below 2%. That's
no disagreement.
And that's okay.
No, numbers speak for themselves. You're absolutely right. I just don't think that inflation is going to do what you think it's going to do, I guess, is the answer.
Well, I'm just going with the trend, right? Because I'm a trend trader. But here's what Bill's mentioning. You had this most recent report by CPI. You can see that little tick up. It was supposed to be, they expected it to be 0.2%, came out at 0.3%. So it did tick up a little bit, which still not bad. But, the good news is...
Exactly, not huge.
Yeah, it's not huge. But you're right. Is this the curl that brings it back up? And that's the unknown. All right? None of us can answer that. Only history can teach us that. And we'll have to wait for that one to happen. So...
But I would point out, and I think we should highlight for the group, the conversation we're having is essentially what the marketplace is doing on a day-to-day basis. I'll speak for the bond market. We get an economic number that comes out that shows the economy is at all slowing down in recessionary figures, and suddenly you're getting a jump in prices and a drop in yield. Then the next number comes out, says, no, we got inflationary pressures or a strong economy. We get an unemployment number that just blows people's minds, or an ADP. And suddenly the economy looks strong, and suddenly yields are skyrocketing and prices are going down. I mean, the market is experiencing this schizophrenia as it's going from number to number, trying to have exactly the same fleshing things out that we're doing here with no clear consensus.
Right.
And in the meantime, the volatility we're seeing in the bond side, 15, 20 basis points a day and changes still.
Yeah.
And I will say, and I'm not the equity guy, so I almost shouldn't even open my mouth, but the equity market obviously has a feeling of optimism that the bond market just doesn't share right now when you look at the inversion.
Right. And it's been, the past 3 months, or actually call it since going all the way back into October of last year, monster run. Here's your S&P 500. If anybody's wondering what that percentage rate of return from the bottom in October to where we closed at today, you're talking 31%, less than a year. In nine months, you're up 31%. That's incredible for a time when you're supposed to be headed in a recession. I mean, that seems broken to me.
As we were talking before we turned in front of the mic, we are more inverted today than we've ever been since 1979. I mean, we're just not a little inverted. This market is trying to send bond market is trying to send a clear signal.
Yeah. And actually, I have it here. So, the only time we've been deeper than this, at least on the 10 versus the 1, was 1980. And we're about 2.7% flipped right now. We're 1.5 on the 10 and the 1. But, we'll stay down there quite a bit. Let me ask you this. This is a question from Dave. So those of you who have questions or comments, you can put your questions down below any of the YouTube videos. I usually add them to the slides, and we go through them when I can. Or you can email me at TraderMerlin@gmail.com. This question came in from Dave. He says, who does the Fed and the FOMC answer to? Who holds them accountable? Does anybody? Who audits them?
Nobody.
How about that?
Well, the Fed, that I can say the IRS in that regard, because the Fed as a corporation, remember, the Fed's not a part of the government, I always have to say. The Fed's a corporation, and as such, they do have audited quarterly financials. So, the financial standards in accounting, although it is somewhat unique to the Fed because they can print and destroy money,
right?
But there's actually audited financials that are open to the public. So as a corporation, they've got that degree of transparency. I think, obviously, he really means more from a policy point of view.
Right.
When the Fed decides to raise by 500 basis points in a year, who are they accountable to? And the answer is nobody.
Oh.
The Fed is the regulatory authority. There are 11 members on this committee that actually voted to raise the rates. And half of those people are political appointees, and half of those, approximately half, are Fed people. And this committee, the FOMC, made up of the Board of Governors and the presidents of the Fed, they get together and do this voting that we enjoyed today. But once these 11 people have this job and they're on this committee and they make the decision to do it, they have the authority and autonomy to just do it. You know, they printed up during the pandemic. They printed up $4.6 trillion of new money. Who in the government approved that decision? Nobody. They have the authority and autonomy to just do it.
Now,
So these are some of the 11 most powerful people in the world.
absolutely. And we can see that's funny. I had a comment today from somebody who was trading the euro, and they're like, this is the popcorn trade of the day because it moves so much. Well, if you're trading any currency against the US dollar at the time of an FOMC announcement, you're almost guaranteed the popcorn trade of the day because it's going to be so volatile. And, it was today, especially not only during the announcement, but also the press conference. That's when the real fireworks and swings happen. One other one, and I don't know where I saw it. I think it came through on one of the message boards, but I didn't get a chance to update it here. With regards to the 25 basis points today, Jerome Powell, obviously the chairman of the FOMC, there if the other voting members all say keep it the same, does he have the authority to go, you know what? I don't care that you all say keep it right where it's at. I'm going with 25 basis points, or does it have to be kind of a majority rules for the outcome of a rate hike or decision from a FOMC meeting?
Great question. It is majority rules.
Oh, okay.
The other thing is, though, because we haven't had actually a full FOMC committee for about 3 years now, we're still lacking members. We lost the number under President Trump, and then he didn't reappoint some, and then President Biden has openings he's just starting to address. So we haven't had a full FOMC meeting for a couple of years.
Wow.
But if there is a tie vote, because we've had even numbers of members, then Powell gets a tiebreaker vote in addition. So I guess in that regard, he has a little bit extra power. But the other thing the Fed has tried to do, since they've started giving us the dot plots, and they show us what each member is thinking, they offer an amazing amount of transparency.
Right.
I'll bring you back to the Paul Volcker days when I started in the market. Back when the Fed used to meet under the Volcker days, they didn't even tell us what they decided. The meeting would disband, and we wouldn't know if they'd raised rates, lowered them. It sometimes took us days or weeks to figure out what the Fed is doing. There was literally no transparency. Now the Fed has a vote. They tell us the same day what the vote was. We give the plot lines what the members are forecasting for the next 2 years.
Right.
I mean, this is an unparalleled degree of transparency we're now getting.
And I have it up here for the viewers at home. This is the dot plot, by the way, and you can see at the bottom, by 2023, it seems like the vast majority of members, that's the first grouping over here on the left, the vast majority of them are saying between 5.5 and 5.75. And right now we are in 5.5. So that's where we're at. You can see the forecast. What's that?
I'm saying just imagine the degree of transparency that offers. Right. What are these individual Fed members thinking going out 2 years into the future?
Yeah. Yeah.
So Powell doesn't have that much more power other than the tie-breaking vote, if you will. But what the Fed has tried to do, since they've offered this degree of anonymity, of transparency, they've tried to show a degree of unanimity. It's really a big deal when one of the Fed members does a naysay vote or doesn't vote the way the group does. As much as possible, I guess it's almost like the Supreme Court in a way. It tends to show a confidence when you have as many members on board with the decision as possible.
Right. Yeah, you want to see that there's a cohesive team there as opposed to no dissensions in the ranks.
Exactly.
You provided some graphics today, which I think maybe we can run through some of those, and I'll get to a couple other questions here. But the first one is you've got a yield curve, what a difference 2 years makes. I'll start off with that one here so you guys can see that. And again, you're basically just trying to show how awkward this inversion has been and how long. Right?
Well, actually, my learning point more than that, because this has really become my bone of contention, is just how dynamic interest rates are here in the U.S. and how the yield curve is constantly shifting and changing in shape and in slope, and what that means and what that tells us and what that's forecasting. And what's interesting is if you look at this chart, recapping the last 2 years, we have all three traditional shapes of the yield curve embedded in just the last 2 years. True. Last year, the blue line, we had a normal yield curve. Now yields weren't great. The highest yield you could get was 2%, but it was still, in terms of its shape, it was a normal yield curve. And then last year, when the Fed started raising rates, long-term rates didn't go up as much. And now we're looking at a pretty flat yield curve last year. And that was just as it was on its way to moving to the inverted yield curve we have today in the red line. So it's kind of interesting as a snapshot. You get the dynamic moves of the yield curve going from the normal curve to the inverted curve, and what that forecast for us.
Yep, I'm writing on here. I'm now adding in text to your slides.
Okay.
I'm a nerd.
So what we're showing here is the biggest change in interest rates was in the short end of the market.
Yep.
Short-term interest rates suddenly become attractive again. Thank you, Fed.
Yeah.
I would point out, everybody listening to this session, by the end of the week, their money market fund is going to yield an extra 25 basis points more for them.
You gotta love it.
2 years ago, your money market wasn't yielding you anything.
And you're getting CDs that are 5% plus now. I mean, that's a
Absolutely.
decent rate. Whereas before you're like, ooh, I got a 1% CD for 12 months. Like, waste my time.
Exactly. No, interest rates are starting to, we're getting the traditional income-oriented buyer looking at the bond market again. There was no reason for them to look at the bond market for the last 2 years.
Right.
But I can get 5.25% on a 1-month T-bill, or 6% on a 1-year corporate bond.
Mm-hmm.
Those are some yields that are getting attention again finally.
Right. Yep. Absolutely. Yeah.
Thank you, Fed. Thank you, Fed.
Yeah. Big Eb says 5.45 on a 13-week T-bill. I mean, hard to beat that.
In this market, it is, exactly, and particularly on a relative basis. So,
right.
No, the bond market is starting to draw in investors again. It's been nice to see. But the yields, what the point is, the yields are so dynamic. Look at that 500 basis point change in 1-month rates in the last 2 years, and less than 2% change in the long end.
Right. Yeah, pretty crazy. We'll see how that inversion continues on, and with the pain it might bring to our overall markets. So talk a little bit about today. So obviously we know they raised 25 basis points, and if we look over here, I've got you have a chart that says what rates did the FOMC raise today. So most are looking at the Fed funds rate, which was up 25 basis points. What were the other numbers?
Yeah, there's actually 4 different interest rates that the Fed raised today, and that's what they do at all the meetings. Now the press focuses on the Fed funds rate, as well they should, because that's the most important number. That has the most impact to the economy. So that one got raised by a 1/4 point. But the other 3 that they raised real quick, the other one is the discount rate. This is the rate that banks can borrow from the Fed. Right? The Fed funds rate is the interbank rate, bank to bank.
Right.
This is Citibank borrowing from Wells Fargo. And the rate at which banks borrow from each other is set by the Fed. That's the Fed funds rate. By contrast, if a bank wants to borrow from the Fed, they have that opportunity also. Usually when they're in trouble. That's how we knew Signature Bank was in trouble. Right. That's how we knew Silicon Bank was in trouble. They kept going to the Fed to get their liquidity. And when a bank borrows from the Fed, that's the discount rate. And that's slightly higher than the Fed funds rate. So if you need to borrow from the Fed, they're there to lend to you, but they're going to charge you a little bit more. So that rate got raised this week also, today also.
How much was that? How much did that get raised?
That's good. That's since the pandemic. Good question. They've maintained that as a 1/4 point higher than the Fed funds rate.
Oh, okay.
So it's been a fixed relationship.
So with that, are they trying to make the Fed the lender of last resort? Like, hey, if you got to borrow money, try your other banks, and if you're going to borrow from us, you're paying a little bit more for that.
That's exactly what it does, and that's how we get the safety of our banking system. That you can always borrow from the Fed if you need to. Very good. Yep.
Okay.
Yep. And by the way, I quick footnote if we have time. One of the questions I often get as a former officer of Lehman Brothers is, why didn't the Fed bail out Lehman Brothers? Mm-hmm. And my answer is, Lehman Brothers wasn't a bank. Remember, the Fed only regulates banks. The Fed only provides capital to banks. Only banks can borrow at the discount rate. So the Fed had no legal authority to bail out Lehman Brothers, even if they wanted to. I mean, it's no mystery that within 3 months of Lehman, why Goldman and Morgan Stanley each became banks, because they realized their vulnerability, because they too had just been broker-dealer firms. So, the banking system gets its security from the Fed, and that's through the discount rate.
All right, good to know.
Yep. All right. Yeah, next one is, this one is getting huge. So the Fed is trying to pull cash out of the economy, right? We've talked about this. There's too much money out there. So one of the ways the Fed has aggressively been doing that is the Fed has been offering a very aggressive, a very interesting rate for the banks to simply hold their money at the Fed. Don't hold it at the bank, hold it at the Fed. And that in and of itself is actually a tightening maneuver. So, and the Fed was paying this morning 5.15 Now it's up to 540. They raised that by a quarter point. So literally the banks get paid 5.4% to do nothing with their money. Just let it sit at the Fed.
Nice.
But realize in terms of economics here, when a bank holds money on their books, they can lend out at approximately a 10-to-1 ratio. As you all know, banks don't actually have the money to back all their loans, but they have about 10% collateral. So if a bank has $1 million of cash or bonds, they can feel comfortable making $10 million worth of loans. But if that same $1 million is held at the Fed, isn't that effectively taking $10 million of potential credit out of the market?
Yep. Yeah.
So the Fed has been saying, yeah, we'll be your safety net. We'll hold your money. And they're doing that because they literally want to pull liquidity out of the market. I mean, last week, every night, there was over $2 trillion worth of money the Fed was holding on behalf of the banks.
Another piggyback question that came in from Dave is this one here. It says, I know the Fed will pay banks not to lend out money, which we just discussed there. That's going to be your interest on reserve balances, or IORB. Is there any regulation that requires banks to lend out a specific amount per year? Like, are they under obligation that they have to lend out a certain amount?
No, none whatsoever.
Interesting. Just curious.
Now that being said, at the state level, which is not our conversation,
right,
I do understand that states have proportions of where the money has to be divided, either by ethnic diversity, geographic diversity. But that's not to say you have to make a loan. It's just that your portfolio has to have certain provisions in it. Yeah. But bottom line, no, you don't have to make a loan.
Oh, don't worry. We'll have gender diversity soon.
There you go. And then the last one they raised today, this is the one that's going to impact your clients the most, because this is the money market fund area.
Right.
So what the Fed also has been doing, just like they said to the banks, we'll hold on to your money, the Fed has said the same thing to large financial institutions, the Fidelities, the Jonases, the BlackRocks. And what the Fed is saying is, you have cash, we'll hold on to your cash. And that's through the Fed lending facility. This goes back to the transaction we've talked about a lot over the years, a repo. This is where the Fed is doing a repo with the money managers, saying, we'll hold on to your cash for you, and we'll give you bonds as collateral. Now, this is an overnight lending rate that some of you are familiar with. Remember the SOFR rate discussion we've had?
Yep.
The replacement for LIBOR?
Right. Yep.
That's what this market is. This is the SOFR market I'm talking about. The mechanism by which they do this is the repo market. So this actually is going to impact your listeners in two ways. Number one, your asset managers, in entering into this trade with the Fed, are now going to start earning 25 basis points more. And as I said earlier, this is why you're now earning a return on your money market funds. Short-term rates have gone up. The unfortunate reality, though, is when the Fed brought this interest rate up, it also means that if you have a floating rate mortgage, your index on your mortgage just went up.
Right.
We used to have mortgages here in the U.S. that were pegged to LIBOR. Now they're pegged to the SOFR rate. So if you're a borrower of money, that's the bottom line. If you have a mortgage and you're a borrower of money, floating rate, your obligation just got more expensive.
Yeah. And that may bring absolutely, and that may bring in a whole different set of problems down the road. And we'll have to see. Anybody who's got a variable rate mortgage or adjustable rate mortgage in a market that's been rising so quickly, that could put a pinch on some people and their ability to make their payments. So hopefully you locked in at a lower rate. I think most people did.
Absolutely. But I got to make a point. Most of the European market is all floating rate mortgages. The UK is completely floating rate.
Really?
I mean, they're talking about their mortgage liabilities are going to triple this year as a result of what the central banks have done in the UK. I mean, everything is float in the UK. That's horrible for the mortgage side. Yeah. Real problems going to develop.
Absolutely. All right. What else is
so
out
optimistic? Yeah, pessimistic.
What's that?
I feel so optimistic. I'm being sarcastic. I feel so pessimistic often when I talk to you. We're going into a recession. Fear and loathing in the UK.
No, hey, look, I think it's not a pessimistic. It's just saying the facts and the data, either whether that's historically through your experience or your personal experiences, telling you that, hey, this is what happens, which is why we love having you on, because I think you need to have different perspectives of how these markets perform. Certainly when it comes to bond markets, you're going to run circles around me. So I love the fact that I get all this information from you. And if it helps me paint a picture for the markets and the economy going forward that I may be able to potentially capitalize on, whether that's through the bond market or the equity markets or currency markets or whatever market, love it. So I don't care if you're pessimistic or optimistic. It's just a viewpoint, and people take it for what it's worth.
Good. Thank you. Thank you. I just worry I get too depressing sometimes.
No,
I am going to point out this. I'm sorry. I jumped ahead. I'm sorry.
no, go ahead. Go ahead.
I just want to point out this is Bank Week. If you have currency traders in the room, which I'm sure you do, we've got a lot of central banks meeting this week. Bank of England, Bank of Japan, the European Central Bank
Yep.
are all meeting this week. Currency market's going to show a lot of volatility. And for the most part, we're looking for India and Japan to continue to be unchanged. They're not going to change their rates. But if you look at every other one of the major ones, we're looking at a 25 basis point hike, it looks like. So it's going to be a lot of unanimity in the global marketplace. There's going to be a lot of volatility.
What's it going to take for Japan to get above the zero line? I mean, when are we going to see that? It just seems insane to me that they've stayed at negative 0.1 for so long, where the entire world's like, we got to raise rates. Like, no, we're good down here. I don't get it. What am I missing?
Been there for years.
I know.
No, and you're not missing anything. And the other thing Japan has done is direct yield curve manipulation. They've dictated that the 10-year JGB, Japanese government bond, will yield 0.5%. And when it yields more or less on any given day, they come in and buy and sell it to get it right where they want it to be. So Japan just doesn't have negative interest rates. You're right, they still do. They also have a yield curve that's being manipulated by the central bank totally. But you know what? It kind of seems to be working.
I know.
Because Japan doesn't have any problem. Japan has the same problems affecting it that the UK does, right? It's an island. It depends on energy coming in, distribution problems with supply chain. And here's the UK running at a 13% inflation rate. And during this entire period, Japan hasn't cracked above 5%. They don't have an inflation problem. So why should they raise rates?
Yeah, but is it just because they're manipulating their rates so much? I mean, I'll bring it up for the viewers out at home so you can see it. This is all the information.
But you can't manipulate.
What's that?
The inflation rate is going to be what the inflation rate is going to be.
Yeah.
I would make the argument the very dramatic actions that the central bank is taking, more so than any other central bank in the world, actually seems to be working better. They're not having the inflation problem the rest of the world is.
And again, that goes back to trusting the data, because I'm like, this can't be happening. There's no way you can keep your pedal to the metal that long and not have any issues for it. I'm actually bringing up, here is a 20, it's not the best looking chart, but it's the only one I could find. This is the last 25 years for Japan. Now, back in 2000, it looks like 7, 8, 9, they were, grab a hold of your chair, everybody. They were at 0.5. They were, 50 basis points. We raised that in a month. Who cares? If I go max,
right,
you can see that historically back in the 70s, they were up at 9% like everybody was in the 80s, but now they've been stuck at this low end. And here's your last 10 years. It basically what happened in 2016. They went from 0 to negative 0.1, and they've been there since 2016. So you're talking, 7 years of just stuck, no changes. I mean, you want to talk about transparency and efficiency. Japan, you don't have to worry about a rate announcement because it's just Groundhog Day for them. Whereas I can go out to the U.S. markets. Let me show you the U.S. markets here real quick. Hold on. That's today. I'll bring up the U.S. markets, and it's like you're looking like a bad EKG. Like, this is cardiac arrestville. Here's ours going all the way back into 2000. It's all over the place, up, down, and we don't really go below 0 on this. We haven't seen negative rates, but this is massive pumps up in 2000. We were up at around 6.5%, then we fell all the way down to 1%, and then back up to 5.25%, 5.5%. It's all over the place. And Japan's like, no, we're good. We'll just stick down here at the bottom and not do anything.
And I would remind your audience, Japan was the first one to try this negative interest rate experiment. When the rest of the world was bringing their interest rates down, we all thought 0 was the bottom.
Right.
And Japan tried this discussion of a negative interest rate. And when during the pandemic, Germany and the European Central Bank also tried it. Now, the problem is they are now starting to experience inflation. So like the rest of the world, they're starting to raise their rates. So they're no longer negative. But as you're right, here's Japan, been sitting there since 2016 without an unchanged monetary policy interest rate change. That's just amazing to me. And yet, it seems to be working.
I know. I think that's the most amazing part for me, Bill. It's like, okay, I look at it, and my brain and the things I learned when I got my economics degree says, that ain't going to last very long. That's going to create a whole new set of problems, yet what I hear and
Yep.
see from the economy, like they don't really seem to have the problems that we do. And it's like, okay, well, at some point, maybe we adopt that here in the U.S., where we punish savers by a negative rate, and we don't have the big inflation problems. I don't know. It seems crazy to me, but hey, I won't
There's
know.
lots
I'll
of studies to come. It is. Oh, yep, I'm with you.
It is definitely a study. I want to move on to your latest editions. I know that finally you have your focus class done for OTA. So let's talk about that. Give yourself a little plug and let our viewers know what's your upcoming schedule look like. So talk to me about your focus course and what that looks like.
Yeah, this is a one-day class committed to just the bond market. And the challenge for me on this class, and it's been fun putting it together, and it's taken an awfully long time, and real thanks to Larry for being so patient and working with me on this. But we're basically trying to educate and appeal to two different audiences, and it's the ones I mentioned earlier. This bond market is offering unprecedented trading opportunities in terms of volatility. So we want to talk to address the trading side of the market. Now, I've expressed I like ETFs a heck of a lot more than I like trading the actual bonds. I'm an old bond trader, but bonds are illiquid. They're decentralized. There's no central exchange. So if you want to trade the market, I love the ETF market. So we talk about that. But there's also, as we talked about, there's the buy and hold investor now. The people who are the traditional bond buyers looking for income, looking for safety. For that audience, I actually do recommend buying bonds directly. Why pay a management fee, a mutual fund fee, any sort of a fee to do something you can do yourself with a little bit of homework? Right. Because most of those clients aren't looking to trade. This is like my grandmother, the buy and hold type of traditional bond investor. They're coming back into the market. So the day is committed, kind of schizophrenic. We've got two ends of the market to appeal to, but we also have to have a discussion about bonds. Because a lot of the people who've taken this class, because we know from the 3-day class signature series we offered 2 years ago, people don't understand bonds as well as they do stocks. You know that.
Yep.
There's an educational issue that has to be addressed. The terminology, the jargon, the structure, understanding pricing. There are some bond basics that really need to be addressed for both of those audiences.
Right.
So that's kind of the common. So finally, we got a program put together for a day. And when the first one is going to be rolled out on September 7th. We've got a full 1-day focus, and it's called the Canary in the Coal Mine. And we're kind of getting that from you, to be honest with you, because since we've been together, you've always talked with me that you view the bond market as kind of the wind in the sails that affects all markets.
Yep.
It kind of is the canary in the coal mine. So even if you never trade a bond, you have to understand the relationship between interest rates, the bond market, and other asset categories like FX, like equities. We saw the correlation today. Were you watching the S&P while Powell was talking? Are you telling me there's no correlation between interest rates, the Fed, and equities? So, we appeal to multiple asset categories, but we really focus on the bond side. So that's going to roll out on September 7th. So in anticipation of that, we've got a 2-hour showcase on the 21st of August. So that's 2 hours, open enrollment, where we're going to get into some of the details, open to everybody. So that's August 21st. And then I also want to put in a plug, because I am starting to do more work with you guys, and I enjoy it. Your audiences are a lot more fun than my institutional clients. So I've had a good time today.
Is it because they're all over 18 years of age?
That's part of it. But they've also got they've got a depth of experience, but they're also not confined in a corporate environment like my other clients are. So we can have more fun. But in August, we've got an XLT scheduled for the 30th. And what I'm going to do is I'm going to demystify a treasury auction. We're going to take the treasury auction and we're going to show you who's buying it, how do we buy it, how you as an individual can participate in an auction, but the role of the primary dealers, the fact that we've got 27 firms here in the US that have to buy these treasuries legally. And we've also got foreign central banks coming in. We can identify them. So we can see who the participants are as to who's buying them and not buying them. And the reason I'm doing that is because of that old debt ceiling problem we had earlier this year, the government is backlogged on paying its bills. We are issuing boatloads of treasuries right now, not only because our current deficit continues to grow, but we also have to play catch up from that whole debt ceiling fiasco. So as a result, we are issuing more treasuries than we ever have. So I thought it might be a little bit interesting to see how that process happens.
Nice. When I think treasury auctions, I picture Janet Yellen sitting there with a gavel going, hey, 25, 50 million, hey, 45. But no, that's not how it works, folks. It's much more civilized than that.
It's not that far. If you have 30 seconds, I have a quick story for you. I started in the industry as a runner. It used to be my job that I would sit at a payphone in downtown Manhattan, right at the foot of Battery Park. And at 12 o'clock, my trader would call me with E.F. Hutton's bids for the Treasury auction. And I would literally run a piece of paper, the 2 blocks, to run into the Federal Reserve building on Broad Street, up to the second floor, and get that piece of paper stamped by 12 o'clock. He called me at 11:58. Literally downtown Manhattan had about 60 young men all running into the Federal Reserve building with bids for an auction. Paper in our hand to bid for the auction. That's how manual intensive it used to be.
And you were in the best shape of your life sprinting those 2 minutes.
Exactly. I was hired because I was a long distance runner in college. It had nothing to do with any finance. I was a long distance runner. I got hired as a runner. It wasn't my finest day when I was running down Wall Street and the runner for Solomon Brothers got clipped by a postal truck and got run over.
I'm laughing with.
Wasn't my finest day. I jumped over him to get my bid in. I couldn't stop.
Oh my
I had to get my bid in time.
Where's the humanity, the compassion, Bill? Where's your sense of humanity? Like, screw that guy. Hey, Kevin, screw you.
I had to get my bid in. I had to get my bid in by 12 o'clock.
That's
we
great.
went back. All of the runners, we were all friends. We went back to make sure he was all right and got him to the hospital. But yeah, the auctions were
after you got
stamped. Bids. Oh yeah, no, priorities. I had to get my order in first. Then we went back to go pick him up.
That's great. That's hilarious. Well, I'm glad he's okay.
Sorry for the story.
Oh, I love it. It's good stuff.
Sorry.
Never apologize for sharing. I think, one thing I hate about this industry is I hate the charlatans. I hate the scammers. As you guys know, I've got a couple people I can't stand. I won't never bring them on this program because I think they're lying a-holes. But I think a lot of people in this industry are just there to sell you something. They're there to lie and tell you how great of a trader they are with no proven track record and pretend that they are an oracle or some deity out there with regards to trading. But the reality is most of the great traders are just common people that have good rules and good sense in place. And you have a lot of experience out there. So I love every time you come on because not only does I think it opens up our viewers here to a different side of the markets because bonds is almost this, no offense to redheads, but it's like it's this redheaded stepchild of the industry. Everybody wants to know stocks. I want to know what's going on in the futures and commodity markets. You don't really think about bonds, but they're so much more powerful. So I love having you on and every time. So share your stories, take your time. Always happy, but I am going to wrap things up here because I got so much to do today.
Okay, that's good. It's always a pleasure, Merlin. I really enjoy you and your audience and the time with OTA. So thank you for this opportunity. I really appreciate it.
My pleasure. So as Bill said, I got it up here on the screen up the side. August 21st, he'll be doing a fixed income focus showcase. On August 30th, he's got an XLT about Treasury auctions demystified. And then on September 7th, he will, I think that's the maiden voyage of his bond focus series called The Markets Canary in the Coal Mine, about the influence of bonds, one-day class out there. If you guys are interested, the link is on your screen. I also put it into the chat, so you guys can click on that link there, otacourses.com /focus-courses would where you'd be to get your information on that one. All right, Bill. Hey, thank you so much. Great. I appreciate you coming on today. Always a pleasure. Have yourself a wonderful remainder of your day, and we'll get you on here maybe next month or right after that.
I look forward to it. Thank you, Merlin. Awesome. Have a great one. Hope to catch up with you soon.
You too. Take care, Bill. All right, guys. How's Bill Addiss, our bond expert? We could have him on here for hours and continue to talk more about the markets, but unfortunately, I have way too many things to do today. I got to wrap this show up here. I've been teaching a cryptocurrency class all day, so I'm exhausted, and I have another crypto thing to do for my digital assets program at 4 o'clock, and I got to walk the dog, who is upset he hasn't left the house all day. So, real quick, as far as markets go, we saw some pretty big whipsaw action in the equity markets. Here, we'll start at the bottom, work our way to the top. Crude oil on the daily time frame, nothing really to speak of here, just a little bit of a hesitation, down 1%. NASDAQ down 0.4%. It did have a good degree of volatility. The intraday chart here was interesting. Luckily, I was teaching class, so I really didn't have too much to do. I was short at one point, and I closed it out and took another small little loss. It's funny, I took a loss on half the position, and then the second half on this last drop here, right around 12:05, when we took our lunch break, got out on that one. So that was good. Pretty much break even. First half was a loss. Second half erased that loss. But anyway, big volatility. Huge up and down action here today, although it's drifting lower in our after hours session. All in all, down 0.4%. It's really what happened in the after hours because you had that Microsoft and Google earnings. Everything looked okay. And then all of a sudden, right as we got to about 3 p.m. yesterday, boom, it started to fall apart. So that was your NASDAQ dollar index. I saw a question earlier about something like the dollar losing its reserve currency status. Let's not worry too much about that. You're talking years before we see the NASDAQ lose its reserve, the dollar lose its reserve currency status. I think it's going to be a slow process if it does in fact lose its reserve currency status. But that's the type of thing that global wars might be fought over, is preserving that reserve currency status. So no real worry about that at this point. S&P was your 5th place finisher, relatively unchanged as of right now. Of course, it's been drifting down in the after hours session. 45.95 is where it is at. Here is your 10-year. I like looking at the 10-year on the daily because you get the bigger picture. You know, today you had a slight down move in that yield. Right now in the new session, absolutely flat. Top 3, bronze medal going out to gold. Gold futures up ever so slightly, although at one point it had a nice big spike, surge up to about 1980, drifting back down right now, trading at 1970, up again 0.3% on the day. Russell 2000 was your best performer from the index side of things, 0.74% move up, looking much better than the other indexes. The Dow was up slightly as well, but the Russell really taking the lead, and that actually ties with Bitcoin, which, you know, has had that pretty big fall down below 29,740, which I've been looking at, and now drifted back up and actually retested that today. So we'll see what happens over the next couple of days. Ben Shorty, quickly, can you explain what the letter Q signifies at the end of a symbol? It means it's going through bankruptcy process. So he's got NOVN, so you had NOVN, and that's Novartis. But if you go NOVNQ, that's Novan. So I'm not sure why the change here, but typically when you have a Q on it, it means it's going through bankruptcy. Going through bankruptcy proceeding. There you go. Does this imply that the shares have become worthless? They may. They most likely will when it's going through a bankruptcy proceeding. Because remember, shareholders get paid last. It's the bondholders that get paid more. And these guys, yeah, it doesn't. Not looking very good, man. That is a brutal chart. Here back in 2016, like, I love this company. They're amazing. Wah, wah. No van. Might be no mo. Anyway, that's going to do it for me, guys. Hope you enjoyed the show. Hope you enjoyed Bill Addiss in the program. If you like today's show, hit that like button. If you're brand new, hit that subscribe button. I do this show every day, Monday through Friday, typically Monday through Friday. Now that I say that, I won't be doing a show Friday. I've got too much going on, and I won't be able to have time to do a show on Friday. So my apologies. I will have a glass of whiskey with you guys tomorrow. Why not? Thursday, I had nothing going on after this. Exactly Talking Monkey, like BBBYQ. That is another one. Also, you know, FRC. So that was First Republic. So you had FRC. Right, that was First Republic Bank, which, you know, looks like it's down here at $4 right now, but it's not. If you go to FRCB, right, that's the bankrupt version of it. They're going through bankruptcy. 35 cents is where it's at. It's been stuck there ever since. So Q's and B's typically mean bankruptcy or some mode like that. Yeah, I think I'm going to the OC Fair tonight, but I got to get ready for my crypto session here at 4 o'clock, and I got to walk this dog because, again, he is upset. So anyway, I hope you guys enjoyed today's show. Bill Addiss, always a pleasure having on the program. Check him out at Online Trading Academy. His focus class is going to be great. I will most likely be in there because I think that bonds are one of the most influential and powerful asset classes, and anything I can do to help steer the probability of a trade or get a bigger sense as to macro picture impacts, then I can structure bigger trades on that. And typically, that's where you get the big runners, is on the big macro picture trade. So thank you guys so much. Have a fantastic remainder of your day. Send your questions at TraderMerlin@gmail.com or down below any of the YouTube videos. I will see you all tomorrow. Take care.